Floor show. We're joined by Chris Oberbeck, Chairman and CEO of Saratoga Investment, with a focus on leveraged finance, and trader Kenny Polcari. Kenny, T-minus about 17 and a half hours before the CPI release. Equities are moving like they're, I don't know, going out dancing tonight, doing the Macarena. Right. No one's concerned this number is loaded with more possibilities that could tank versus pump up the market. Should they be?
Well, listen, the way the market's reacting, it's as if it's playing I've got a secret, right? Somebody knows something. Yeah. Because if the number comes in stronger or up 0.4 or up 0.5, I don't understand why the market would be celebrating. Not saying that it should crash, but this move today seems a little bit odd to me in the face of what we are now saying could be even a harder number than what the market expects. And so therefore, I think people need to just be prepared for that, right? And there are a couple of ways that you can do it, right? If you don't want to, you want to stay long your portfolio and all that stuff, so you buy protection. It's going to protect you to the downside. So whether it's, the VIXI, which will spike in price if we get this sudden turn of events, you might want to buy the PSQ or the SH.
Okay, so explain to people the VIXI and exactly how it could protect them.
So the VIXI is a way that if the VIX spikes, which is the fear index, right? So if we get a hotter number and then suddenly the fear goes up and the Fed gets more aggressive and stocks start to come under pressure, the VIXI will increase in value, the volatility will spike up, and the VIXI will increase in value. So therefore, it'll be the contra to what the market's doing, right? The market will sell up, but the VIXI will increase. So that's one way to have some protection on your portfolio. Okay. But the other way to do it is to go long the sectors that are going to, like the PSQ is getting short the NASDAQ, right? You buy it to get short. So if the NASDAQ goes lower, the PSQ goes up. The SH is the same thing. It's the S&P short, right? If the S&P goes down, the SH increases in value. And the same with the DOG, which is the Dow inverse, right? The contra trade.
Sure. Okay, so great ideas here. Now we bring in Chris, because Chris, you are looking specifically at what you call business development companies. They have been performing beautifully here. Explain to our viewers why these are the better ways. Not better than VIXI for sure. I mean, just equally as interesting, you say, as when it comes to protecting portfolios.
Well, I think business development companies largely lend to corporations. In our case at Saratoga, we are the senior secured most, 80+% of the time. So we're at the top of the capital stack. And so it's a long-term contractual agreement to get your money back plus a return. Mm-hmm. And then on top of that, our assets are correlated to interest rate rises. So most of our 80% plus of our assets are floating rate. And so as rates rise, our income rises and our liabilities are fixed, so our margins are expanding. Mm-hmm. And it's an agreed return. I'm reminded of Will Rogers' famous statement, return of my money is more important than return on my money. And so
we would like return of both. That sure would be nice, but
exactly. So private credit gives you a chance to do both.
Did you happen to see the New York Fed consumer survey that came out today? It showed that I believe the wage disinflation that survey respondents actually expect, so disinflation meaning they're coming down in inflation, largest one-month drop in the 10-year history of the survey. How do these business development publicly traded companies, FDUS, and then you've got the the BDC that's SAR, which is of course Saratoga, how do they respond or perform if we have a disinflationary environment?
Well, I think one of the things that we try and do is we invest in software as a service companies that are largely efficiency drivers, and they're smaller companies, so they don't necessarily correlate to the larger economy. They're not retail or housing and that type of thing, or energy. They're very much focused on efficiencies and making companies more efficient in the way they interact with their customers, the way they do their accounting, the way they do their HR, those types of things. And so even if the economy is going down, even if things are disinflationary, efficiency is a good investment for companies, and that's what we invest in.
So you give the examples of FDUS and SAR, correct? So, correct. Kenny, when you look at that and then you look at this is a pretty good rally here. Look at the Dow Jones Industrials, folks, up 302 points and climbing right now. Do you get the sense that people are very bullish now on tech and that may continue, or is this simply one of those days where we start off the day before a big event like the Fed meeting or CPI with a lot of hope and then it all ends in tears once the number or the decision comes out?
Well, listen, I think people are warming up to tech for sure. Look, the Nasdaq is up, I think, 12% year to date, far and ahead of the Dow and even the S&P. So the tide is turning in terms of how people are feeling about tech and the role it's going to play, considering it got smashed last year in 22. So there is a lot of opportunity in the tech space. But look, I think you have to go into tomorrow and then Thursday's PPI number with some caution, because actually the PPI number is supposed to be up even more on a percentage basis than the CPI number is. And remember, the PPI is what the producers are paying to manufacture the products that they then sell to you 3, 4, and 5 weeks later. So that filters its way through. So I think you have to really be just kind of cautious and not get way ahead of yourself, which I do think the market is just a little bit ahead of itself.
Well, and let's not forget the yield curve inversion, Chris. I mean, between the 2 and the 10-year yield, I believe we've got a yield curve inversion of, what, like 120 basis points or something insane? Yeah, 120 basis points. So off and on, this, of course, indicates fear of recession. We haven't seen it yet. We had the guy who even came up with the yield curve inversion signifying recession, saying this time it's wrong. What do you think?
Well, I think, there's a lot of opinions out there, right? And the stock market clearly appears to be thinking there's going to be a soft landing. Maybe it's a short squeeze, I don't know. But there's a lot of rally there saying it's going to be a soft landing, where I think if you look at the debt markets, they think it's going to be a hard landing. Yeah. And they think interest rates are going to come down quite a bit. So those are two different perspectives. And then you also have the Fed saying they're going to keep higher for longer, and the market's projecting short-term rates coming down as early as the end of this year. So there's a lot of differing points of view there to sort out.
He's right, Kenny. Yeah. We all have opinions. And of course, crystal balls don't really tell the true story. Great to have you both, Chris Oberbeck and Kenny Polcari. Thank you so much.